Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Well, we've gotten a few surprises in terms of economic data out of both China and Japan over the past couple of months. For instance, we had a pickup in Japan's exports. We also had a pickup in Chinese exports. Joining us now for some discussion about what we're doing is Qian Wang, Chief Asia Pacific Economist at the Vanguard Group, with us live here on the program. So we looked at those export numbers from China, and we decided that maybe we shouldn't read too much in. At least Bloomberg Economics was saying that some seasonal factors at play there and a few other reasons to think that way. What about your take on the latest with the Chinese economy?
Well, I think the exports actually has been indeed a very key growth driver for China, over the, past several months, right? So one thing I definitely think there is, pick up in terms of a global consumer demands, right? Or capital spending. This is actually reflected not just in China's export number, but also general export-oriented, Asian economies, right? On the other hand, I also feel like there is a push for China, right, to export its excess capacity, right? China's industry policy, Made in China 2025, they made so much investment and production pickup, but domestic demand is really weak, so they have to rely more on the export sector, right, to absorb those excess capacity. So I think that's where the exports is pretty strong, especially in volume terms. I think it's growing like 10 to 15% in volume terms so far this year, even though the export price actually is, deep in deflation. I don't think this is sustainable. There is no unlimited demand for China products, right? And also there's going to be trade tension, down the road. U.S. already imposed tariff, and then, Europe is joining suit. And, we see that Turkey is also imposing tariff on China's EV as well. So I think this is not something that's going to sustain down the road.
What about the deflation story? We'll get inflation data for China in the week ahead. Factory gate inflation is expected to slow to 1.5%. That would be the smallest drop in prices since February 2023, but it's deflation nonetheless. Is your sense that we're beginning to find a bottom right now, or is there risk that this deflationary trend turns into a deflationary trap?
Right. I think it's an interesting story about China's, inflation or deflation story, right? So when you look at China's growth, at this moment, when they have such a big investment boom, production boom, right, it immediately lift up its demand for, capital goods, commodity, especially industry metals. So on that front, it's actually inflationary, right? That's why China's commodity imports actually has been holding up in spite of the property downturn. But on the other hand, when you have so much production capacity and domestic demand is pretty weak, then this kind of supply pressure is generating a significant deflationary pressure as well, right? So I think the impact is somewhat mixed, but overall, if you look at the CPI, you would say yes, the headline CPI is probably likely to hover around 0 positive, but if you look at the core goods CPI, it's still likely to be in the deflationary territory.
Well, in China, the policy is basically directed at the state sector more than the consumer sector. I mean, that's been what we've been seeing. And it sort of raises a question about whether Deng Xiaoping's "to get rich is glorious" still holds in China, because the policies don't. I think it's probably cynical to say that Xi Jinping doesn't want people to get rich. He wants the state-owned enterprises to get rich. But, that's some of the things that you hear from people.
Well, I think over the past several years, you do see a shift, right, in terms of China's policy priority, right, in terms of their goals. So instead of say, oh, we allow some people to get rich first, now you do see more emphasis on, like so-called common prosperity, right? You just want to make, like there's more emphasis on income equality, national security, many other things, right? So I definitely see there is a shift in terms of the policy goals, instead of the growth rate itself, but also on growth quality. So I do see that's changing. And also, I think on the other hand, from a cyclical perspective, right, when the government want to support the overall growth picture, then boosting up investment is actually much faster, much more effective than trying to stimulate up the consumption. When consumers are lacking the confidence, when they get the money, they would rather just save rather than spend.
Yeah, that's particularly true where young people are concerned, I would imagine, when you're dealing with an unemployment rate that is so high in China.
Indeed. I think, we see this new youth unemployment rate number, right? 15% still high. But even I think we shouldn't just focus on one indicator to gauge the overall labor market condition. I think in China, what is more concerning for the young generation is actually the declining labor force participation rate, right? So when you see that they are not confident about the future, about the labor market or job prospect, then they become discouraged and they stay home, prepare for civil servant exam or graduate program exam, right? So they literally just drop out from the labor market. So I mean, that just shows you the sentiment in the labor market is pretty weak.
So, Ms. Wang, do you think that the government should and could do more on messaging to build up hope in the Chinese dream?
Yeah, I mean, I think the key here is really when you look at the economy, right, and look at the labor market, I think ultimately the most important thing is still about overall economic growth, right? So when you have a stronger economy, then obviously that's gonna, create more jobs and bring more hope and income to consumers, right? So in that way, you can actually build a positive self-fulfilling cycle. But then, going back to say what they can really do. Number one, I think they need to be more aggressive, right, in terms of the government intervention in the economy to engineer a decisive turning point. And second, I think private sector bring the animal spirit back. Private sector is really the key.
Yeah, that would be great. Great to see for sure. And thank you so much for joining us, Qian Wang, Chief Asia Pacific Economist at Vanguard Group, with us. So a very interesting picture, and we have James Abate, Managing Director and Chief Investment Officer at Center Asset Management, to help us clear up the picture a little bit. James, thanks very much. So a sort of big reaction to the jobs report in the Treasury market, not so much in the stock market. And I mentioned in our papers review just a few moments ago that Bloomberg Intelligence says rates, while important, are not actually factoring in as much as artificial intelligence is. Your thoughts on the overall environment?
Well, let's just look at the employment report. As you mentioned, 272,000 jobs were added, which was way above expectations. I think more importantly to the Fed was the fact that wages were up 4.1% from a year ago. And in reaction to that, we saw the 10-year yield move up to 4.4%. And in essence, what this did is, obviously, the Fed is meeting this week. There's no cut on the table for this month. July's cut is off the table in terms of what the market is pricing in. September is now 50-50, and November seems to be the only indicative cut. Obviously, the only wild card we have is the CPI release this Wednesday. But I think, one of the key points that you pointed out as well was the fact that it's very difficult to reconcile the payrolls report to the employment household survey, which indicated that, yes, the unemployment rate rose to 4%, and the participation rate fell to 62.5%. So the household survey showed 408,000 jobs lost, which is 700,000 jobs difference to the establishment survey.
What does that do in terms of the way you're approaching markets right now? If you look at the bond market, I mean, clearly it's kind of a very hawkish tone in terms of the implication for Fed policy. Maybe we're lucky we get 2 rate cuts this year, but that big spike in yields definitely sending a message. But what does it do to your strategy? How are you approaching markets now?
Yeah, I think we went into the year under the assumption that the Fed was not going to cut rates unless it was in reaction to some type of financial or geopolitical crises, and we stick by that. And when we survey all the companies that we invest in and look at, I think one of the key things for us is looking at the consumer, because the manufacturing sector remains in slight contraction or even stall speed, if you want to call it that. No recession, but vulnerable to some type of demand shock. And you could even argue on a positive side that the cyclical economy's bottom, but not yet entered into an upturn. But more importantly, the consumer, which dominates the U.S. economy, we're starting to see, stress, and particularly when you're looking at a lot of value-seeking behavior in lower and middle income consumers at this point in time. Deutsche Bank had their global consumer conference this week, and spice company McCormick used a term that I'm going to continue to use, which said financial anxiety in the last couple of months has really spiked in the United States, and it's something that they're paying a lot of attention to. And that was a consistent theme that we saw with all the companies that are consumer facing.
I'm curious, what do they mean by financial anxiety? Do they mean just general economic, people feeling comfortable about, their job and their money and that sort of thing? Or do they mean actually tied to markets and to, for instance, their returns?
When you look at anecdotal information, right, you see IRA hardship withdrawals spiking higher. When you look at adjustable rate mortgages, they're resetting now because many buyers who used adjustable rate mortgages who bought in 2021 are on that 3-year maturity schedule of resetting what the rate is. I think across the board, what you're starting to see, whether it's particularly in the lower and middle income consumer, some degree where the rise in interest rates has created like this frog boiling in a pot of water. And it's just starting now to get to a temperature with the consumer starting to feel that anxiety that we touched upon.
So if you're right, I mean, we're going to get the, I think, University of Michigan sentiment figures at the end of this week. Say you're right, James, and the Fed is going to begin factoring that into its decision making. They want to see a soft landing, I would imagine. Is inflation at a point that is within the comfort zone where the Fed could justify cutting interest rates right now?
Not yet. I think they could only justify a rate cut with inflation elevated above their 2% target if you saw, let's say, another regional bank issue, a real estate issue that manifested itself in the banking sector. Everything at the end of the day always makes its way into the financial services sector in terms of stress. So I think the Fed can only use that justification to actually cut rates in the face of north of 2% inflation.
I mentioned Bloomberg Intelligence. I got to go back to this because this is a slightly different angle. They actually referred to AI as kind of driving things, but they said it's clearly now well extended and almost hinting that it was overvalued. And so a lot of people seeing what NVIDIA has done, they're clearly worried about this. But, if you kind of refer back to 1999, we did get a warning from Cisco, but it still took a while. And we haven't had a warning yet from NVIDIA. Are you comfortable, at least if you're playing tech, to carry on until you get a warning?
Well, having been one of the very few people who are still managing money today and managing money back in the 90s, not only managing U.S. equities, but also I was head of global sector funds, including running 3 different technology funds at that point in time. For now, NVIDIA has a monopoly on semiconductor chips that's needed for the computational power for AI. I think what contrasts today versus back in the late 1990s is that all the presentations I recall anyway, that were industrial in their nature. They stress return on investment. You looked at enterprise resource planning, ERP systems like SAP, Oracle. All the presentations back then were justifying what the return on investment would be for companies who undertook this. I think Silicon Valley feels like it's in this fake it till you make it, mantra that's still in place. And, one of the key things for us that when we talked about AI in our insight piece for spring and summer is that we wanted to really try to understand what the efficacy of these investments being made today. And when are we going to start to see chief financial officers, exert more influence on budgeting in a way from, this field of dreams, build it and they will come kind of mindset. And that's the thing that we're really focused in on in terms of, looking at AI systems that are using proprietary data versus open source and trying to understand at what point will people, genuinely start to look at this and say, hey, what is the return on investment that we're getting from all this money that we're plowing out? And unfortunately for other tech companies like Salesforce and Accenture, the consulting guys, AI is hoovering up all the IT budgets for almost every company out there, and it's causing a lot of segmental stress within the technology sector.
Yeah, for sure. I mean, software in particular, a lot of those companies are down quite significantly, 25% even. So it's like you say, it's hoovering up a lot of business. James, thanks for joining us again. James Abate, Managing Director, Chief Investment Officer, Center Asset Management. Joining us now on the program is Redmond Wong, Chief China Strategist at Saxo, with us to take a closer look at, China in particular. So, Redmond, thank you for being with us. We know that China is relying on exports and manufacturing and sales abroad to offset some of the weak consumer spending. So far, it seems to be working to a small degree. Is this the right policy in your view?
Hi, thanks, Brian and Doug. And I think, exports seems still have been, doing pretty relative well versus the pickup in the domestic consumption. So, yes, I think that's continued to be one of the area that the government would like to push. But of course, there's some pushback from the outside on all those allegations of excess capacity and so on. But one major thing I need to pinpoint is the reconfiguration of the trading pattern. I mean, you have been seeing the growth. For example, in May, you see the export growth in China and the 7.6% year-on-year growth. Actually, half of it is actually growth is actually accounted for by the growth to export to ASEAN country. And in some of the ways, I think that's the one key thing is the change of a trading partner and the pattern of trade.
Redmond, I think we can agree that domestic demand in China remains weak. Is there a policy prescription that the government can use to try to revitalize domestic demand, do you think, other than lowering interest rates?
I think they have tried quite many front and many policies, like, for example, in the autos and the EV and so on. And they just, roll out in late April and the one in the trade-in subsidies and so on. And also they also encouraging a lot of those kind of household home appliances purchase in the rural area and all those kind of things. But I think the key thing for China, I think pretty much is really bringing back the confidence of the private sector and also the households' expectation of the future income and stability. So I think a lot would depends on a more stability, especially on the expectation of the regulatory framework, rather than on any individual policy or any. So I think we have. I know. We cannot really hope on any one of those is a meeting, but still, the July panel recession still carries some important signal, and I think the market should pay attention to it rather than just on individual policies.
Redmond, if you look at artificial intelligence, it has really juiced up the U.S. economy, more so than Europe and more so than Asia. If China were looking for some sort of killer app or something to get the animal spirits going, this kind of rides on the back of Doug's question about policy. But is there something out there that might get people excited to start spending again? And if so, what would it be?
I think it's once again it's really from the household, it's really on the outlook on employment and also on income. And so that is, I think, the key questions really from employment and income, rather than any subsidies or any policy to just for the sake of boosting consumption. So I think it's in China the policymaker always have those kind of traffic lights kind of things. I mean, it's not a good thing, but that has been the case for years. And when the economy doing not that well, they will relax a lot of regulatory framework and give some green light even to the private sector, or as you mentioned, to the technology sector and so on. So that probably can help as well.
One of the criticisms levied against China and its current situation on the part of both the U.S. and Europe has been this issue of overcapacity. How serious a problem is overcapacity in China, and what will it take to kind of bring things into balance to the extent that the U.S. and Europe are not outraged by what China is trying to do?
I think we really need to look at the whole thing. It's more in the context of this kind of global de-risking, reshoring, nearshoring. It's basically it's what we call is a geo-economic fragmentation trend that has been going on since over the last few years. I think China, that certainly, because it's in industrial policies. I mean, it's one of the focus has been over the last few years be industrial policy. That definitely, of course, there might be some misallocation resources. You're building up capacities in an area that may not be the what the economy needs, but at the same time, you may also lacking something in other sectors. So I would call it's more like a misallocation of resources rather than really excess capacity. And so, but going back to your question, the external environment, I think this pushback will continue, because that not just in the US, but in Europe, is actually elevated to not just on economic consideration, but it's actually on the national security and consideration. So that's why it's a geo-economic trend. It's not just an economic trend.
Well, something that would be safe on the national security front would just be domestic travel. Could domestic travel get things moving a little bit? And if so, how do we play that in the markets?
I mean, it's when people have more income. It's a domestic travel definitely is a positive, and but at the same time, I think the most fundamental is still on income and also on expectation. Rather than just one or two quarter kind of consumption. I mean, back to the basic. I mean, the growth for an economy by the end of the day is the capital accumulation and also more production and not just consumption.
All right, Redmond, thanks so much for joining us here live on the program. Redmond Wong, Chief China Strategist at Saxo. Joining us now to define this complicated picture that we have mentioned is Brian Krawez, president of Scharf Investment. Brian, thank you very much for joining us. So, big reaction in the Treasury market to the jobs report with yields popping in the mid-teens. Not so much in the equity arena. Stocks taking it kind of in stride. Why the difference?
I think, U.S. stock investors are still really focused on AI and earnings. Earnings growth has come in pretty well, whereas obviously, as you've said, rates have ticked up a bit. Although if you look historically, a 10-year around 4.5%, that's actually, still historically very low compared to, the average over the last 50, 60 years.
You mentioned the AI trade there. NVIDIA will begin trading on Monday on that split-adjusted basis. So when the company reported quarterly earnings, they announced that 10-for-1 split. Are you still enthusiastic? Maybe you never were. I'm going to just go out on a limb here. Are you still enthusiastic on the AI trade and anything related to it?
I mean, AI is going to be a very interesting technology, but from an investor perspective, obviously these stocks are very expensive. You mentioned Apple will have an important day on Monday for them. We're looking at Oracle coming out next week, and we think that's a cheaper way to play AI. It's roughly in line with the S&P multiple, but you're really seeing their growth accelerate as they're also taking advantage of AI growth in their services.
I can tell from your notes, though, that you're sort of feeling like 1999-ish a little bit here, and that we're kind of getting to that moment. The one thing I would counter that argument with is that we did get a warning. Cisco warned in December of 1999, and the stock continued to go up until March. Oh, we haven't had a warning from NVIDIA yet. Do you think it's at least safe to wait until we get some warning from one of the big practitioners?
For sure, it's likely that fundamentals on the AI trade, particularly names like NVIDIA, are going to post very strong earnings for a while. I would point out for NVIDIA holders that 24% of their revenue are coming from two companies, one of which is Microsoft. And Microsoft and others are aggressively looking for alternatives. So it's really hard to say when, the fever will break in terms of the AI trade. I mean, your kind of implication is, well, maybe investors can wait until they get a warning, and that may or may not work. But if you look at sort of what we're looking at more as the average stock, and if you look at the average stock over time, and that is the average stock in the S&P 500, typically you've gotten outperformance, but last year and this year, you've seen the S&P, which is market cap weighted, really outperforming the average stock. So we think there's better opportunities outside of some of those big AI leaders that everyone's talking about right now.
So Brian mentioned that very strong employment report and the push higher in yield across the curve in the Friday session. Where are you right now in terms of the Fed cutting interest rates, and how important is that in driving this market higher?
Well, there's kind of a two-part question. In terms of the Fed, we actually believe rates are going to stay higher for longer. It's going to take a little while to sort of break the fever pitch. You've gotten mixed reports, but generally speaking, things haven't come off as fast as the Fed would like. So we think rates will probably stay higher for longer. The reality is, if you look at rates, as I mentioned earlier, 4.5% on the 10-year is not actually very high in the historical context. And so we think rates will be higher for longer. In terms of stocks, we actually think higher rates longer term will be good for value. If you look at historically, when rates are above 4%, value tends to outperform growth. So we actually think that even though there's a big AI trade going on, longer term, investors should be thinking about value stocks, which have been sort of left for dead the last 10 years.
A few economists have kind of waded into sort of controversial areas by saying that high interest rates are actually good for the economy. A lot of people that never got any yield on any of their savings for such a long time, going back to 2007 or so, are finally getting some, and it's helping with spending. I'm curious about your take on it. I don't want to sound glib in saying, do you buy that? But I mean, is there some sense in that?
Yeah, no, I think there is. There's an interesting book that came out just recently called "The Price of Time" that goes into historical rates over the last 3,000 years. And I think if you really look at the data, there is definitely some argument to be made that lower rates just in some ways sort of really distort the economy. And ultimately, higher rates will be good for savers, will be good for certain types of businesses, and might actually help to make sure that people are making good capital investments as opposed to just speculating when you can basically get money for free. So I would say that that's a very plausible type of argument that some economists are making.
So what's the House view over at Scharf on markets offshore right now? Move away from the United States and let me know what you're thinking, particularly as it relates to Asia.
Yeah, I mean, offshore markets are very interesting in that they trade at a much lower multiple than the U.S., so that you got a valuation support there. The problem has been earnings growth, and then you've also had situations like China where the government has really turned sort of unfriendly for investors. So it's been really not a good place to be the last several years. However, we do think there's some opportunities in the rest of the world. We own a number of stocks outside the U.S. One that I would note in particular is Samsung. It's the largest tech company, one of the largest tech companies in the world by revenue. It's really a stealth way to play AI because of their memory. And if you look at demand for AI servers is supposed to grow 30 to 35% a year. That's definitely going to help Samsung semiconductor division. And yet it's trading just over book value, around 11, 12 times earnings. So if this was a U.S. company, it would probably be trading at 3 times where it is today. So we think that's an opportunity investors can take advantage of.
We did have the dollar pop in addition to yields, and that's a little worrisome for some markets out here. Hong Kong almost certainly will trade lower today because of the exchange link. So it's important to look at the data that we got and see what's real. You had the establishment survey with that big number, 272,000, but the household survey had unemployment rising up to 4%. Which one is right?
Well, time will tell. They're probably both somewhat right, but we think that economy is still reasonably strong. But from our companies that we've been listening to, it seems like there is a little bit of a slowdown starting to percolate up. That doesn't mean that necessarily the Fed will be able to cut rates in the short term, though. But eventually the economy will roll over and you'll get a cut in rates. I would say probably later in the year.
Yeah. Bloomberg Economics looked at the data and came away and said, we still think the U.S. labor market is cooling. So it is interesting. Thank you, Brian, for joining us. Brian Krawez, president of Scharf Investment.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.